When will the bubble burst? Stay tuned and I'll tell you next. Hey, welcome back. It's Lance here. Today's housing market update I'm going to share with you is regarding the possible collapse of the real estate market. Lots to cover in this video, so before we get into it, hit the like button. I greatly appreciate that, and it helps support the channel. And consider subscribing if you haven't done so already. I post videos about how the pandemic is affecting our housing market and sharing with you the latest news and updates. Let's get into it. With rising real estate prices, low inventory, and a backlog of new home construction, many consumers are wondering if what has gone up must come down. In other words, are we on the verge of another housing market crash? Many people are worried that we may have a repeat of 2008. 15 years ago, few expected a global housing crisis fueled by low interest rates, lenient mortgage lending standards, and the widespread belief in home ownership. Home values soared at record rates. In the years following the housing bubble burst, some 9 million families lost their homes to foreclosure or short sale. Property values fell 30% or more. Homeowners lost more than $7 trillion, and it took nearly a decade for most markets to recover. Even today, many local markets have not fully recovered. With recent market activity, are we in for another housing market crash? The short answer is not likely. Today's boom cannot last, but a crash this severe is highly unlikely due to several determining factors. I'll tell you them right now. Reason number one, tougher lending standards. Congress and federal regulators were forced to adjust the mortgage lending system after loose mortgage lending practices brought down some of the nation's largest banks and mortgage companies. Consequently, standards of mortgages have been raised, and the process for obtaining a mortgage is now more transparent. Anyone can get one. Type of loans are now illegal, while borrowers must undergo rigorous income and asset checks. This new regulatory framework will be enforced by an entirely new regulatory agency, the Consumer Financial Protection Bureau. Lenders who do not comply with these guidelines will face severe penalties. As a result, the housing finance market is stronger and safer today than it was 15 years ago, safeguarding any dip in the housing market. Reason number two, mortgage forbearances. After the housing market crashed in 2007, a flood of foreclosures pushed supply into areas with falling prices and weak labor markets, which prevented previously foreclosed borrowers from re-entering the market as buyers. According to the Federal Reserve, foreclosures during a time of high unemployment could lower prices, plunging homeowners deeper into negative equity. In the pandemic era, the effects of mass unemployment were unlike those of the Great Recession, thanks in large part to a program called forbearance, which allowed homeowners to postpone their monthly mortgage payments without suffering penalties. The pandemic economy has slowly recovered, thus many homeowners have resumed their employment and therefore their mortgage payments. As of early March 2021, mortgages for 2.6 million homeowners were in such forbearance plans. According to CoreLogic, mortgage delinquencies declined 5.8% by the end of 2020 due to the forbearance program. A share of mortgages 60 to 89 days past due declined to 0.5%, down from 0.6% in December of 2019. Serious delinquencies, defined as loans 90 days or more past, including those in foreclosure, increased when those with large loans abandoned forbearance. By year-end 2020, the serious delinquency rate was 3.9%, up from 1.2% in December of 2019. Inevitably, some owners in forbearance will not receive loan modification or a lengthy repayment period from their lenders. In the absence of a government bailout for these beleaguered owners, they will lose their homes when forbearances end. A significant increase is expected from recent levels, but still far away from the 6 million foreclosures following the 2007 crash. According to Atom Data Solutions, at least 200,000 defaults are projected by 2021, as well as a 70% increase in foreclosures thereafter. Reason number 3, current home equity amount. A home's equity is the difference between its current market value and what you owe. That is to say, equity is how much of your home is actually yours. Equity can encourage you to stay in your home longer. If the prices rise, as they have almost universally done in recent months, your equity increases too. Why is this important? The higher the equity level, the less likely homeowners are to default when their home value falls. In the past 10 years, American homeowners have experienced house stability and growth, amassing considerable home equity reserves. Approximately $26,300 in equity was accrued by the average homeowner in the third quarter of 2020. Remainder of the year, the average family had a mortgage balance of $194,000 and equity of $194,000 respectively. During 2009, nearly a quarter of mortgage homes were less than the amount their owners owed on their mortgages. Reason number 4, price growth will slow but not stop. After the COVID-19 pandemic was declared in April 2020, real estate sales boomed, which surprised many industry economists, and the real estate sector, like most others, was expected to lock down. However, by April, sales were soaring as buyers, many of them millennials, took advantage of historically low mortgage interest rates. Rates remained below 3% through the end of 2020, and home sales exceeded their highest level in 14 years. The combination of solid sales and depleted supply drove the median existing home price nationally to $309,800, up 12.9% from December 2019 and marking 106 straight months of year-over-year gains. It is anticipated that the multi-year trend of significant price increases will end, if only temporarily, but the inflationary pressure on entry-level homes will endure until new home construction relieves it. Analysts at Fannie Mae, Freddie Mac, Mortgage Bankers Association, and National Associations of Realtors predict median home prices will increase between 3 and 8% in 2021. This is a notable drop from 2020, but no crash like the last housing crash. While no one can predict what will happen with the real estate market, experts are confident that we'll experience a dip, but not a crash. However, it's still important to stay informed of market trends, consumer sentiments, and expert insights. If you like this video and would like to stay updated, subscribe to my channel and hit the notification bell so you'll know every time I post a new video. Thanks for watching, and I'll see you next time.